All right, let's talk about a big one, the S&P 500. You've definitely heard of it, right? I mean, chances are you own it in your pension or an investment account somewhere. But do you really know what it is? Today, we're going to peel back the layers on this famous index and separate what we think we know from what's actually going on. Okay, let's get into it. First things first, let's just wrap our heads around the scale we're talking about here. Get this, a whopping $15.6 trillion. Trillion with a T. That's how much money is either directly invested in or benchmarked against the S&P 500. So yeah, this isn't just some ticker symbol you see on the news. It is a financial titan, and its influence is just massive.
And that brings us right to the heart of the matter. This quote from Adriana Robertson absolutely nails it. There's what we think the S&P 500 is, this neutral, automatic snapshot of the market. And then there's what it actually is. And believe me, there's a pretty big gap between the two. So what's the reality? Let's dig in. All right, first up, we're going to tackle the 5 biggest myths out there. These are the common assumptions that millions of us make when we invest our money. And I'm willing to bet at least one of these is going to make you go, huh, I didn't know that. Okay, myth number 1. This is the biggie. We buy an S&P 500 fund because we think, great, I'm diversified, spreading our risk across 500 of America's best companies. I mean, that's the very definition of diversification, isn't it? Well, not quite. The reality is all about concentration. Just look at this. That one huge slice, that's the top 10 stocks. Just 10 companies make up 38% of the entire index. And to put that into perspective for you, back during the infamous dot-com bubble, which everyone remembers for being super top-heavy, that concentration was actually lower than it is today. So this isn't broad diversification. It's a massive, concentrated bet on just a handful of giant companies. And here's another way to think about it that is just wild. The top 3 companies, just Apple, Microsoft, and Nvidia, carry the exact same weight in the index as the bottom 362 companies combined. Let that sink in for a second. 3 versus 362. So if one of those top dogs has a bad day, your diversified fund is going to feel it in a big, big way. And that leads us perfectly into our second myth. A lot of us just assume that if you invest your money in an S&P 500 fund, it gets split up evenly 500 ways. I mean, it seems totally logical, right? But that is not how it works at all. You see, the S&P 500 is market cap weighted. It's a fancy term, but all it means is that the bigger the company, the bigger its slice of your money. And the result is pretty staggering. Let's say you invest £10,000. About 700 of that goes directly into Apple. And the smallest company in the index, it gets about £1. 1. That's a 700 to 1 difference in your ownership. So no, you're not owning 500 companies equally.
Okay, next up. We hear this one all the time on the news. The S&P 500 is up today. Great news for the economy. We automatically think that if the index is doing well, the whole US economy must be doing well. But is the index really a mirror of the economy?
Not really. Here's the key. The index represents the stock market value of these huge companies, which is a very different thing from their actual contribution to the economy. I mean, look here. The tech sector makes up a massive part of the S&P 500, but its actual share of the US GDP, way, way smaller. And think about this. Small businesses, which employ nearly half of all Americans, aren't in the index at all. So the S&P 500 is a proxy for the largest public companies, not the economy as a whole. This next one. This one might be the most dangerous myth for investors. We look at those amazing historical returns, 10%, 12%, 13% a year, and we just assume that's what we can expect going forward. But history always comes with a huge asterisk. And that asterisk is your starting point. The valuation of the market when you invest matters a lot. We measure this with something called the PE ratio, which basically tells us if the market is cheap or expensive. Right now, it's sitting around 25, which is way above the historical average of about 19. And academic research is pretty clear. When you start from a high valuation like this, the next decade of returns tends to be lower. It's not a guarantee, but it is a strong historical headwind. And finally, we come to the myth that gets to the very heart of this whole thing. We call it passive investing, right? The idea is that there's no fund manager actively picking stocks. It's supposed to be an automatic, hands-off process. But is it really? And this brings us to the big revelation. Far from being some automatic list of the 500 biggest companies, the index is actually the product of active human decisions. Yup, meet the S&P Index Committee.
There's a group of actual people at S&P Dow Jones Indices, and they make the final call on which companies get in and which ones get kicked out. Now, they use criteria, sure, but the final selection is, and this is a quote from their own rules, at the discretion of the index committee. That's active management, plain and simple. For example, they have a profitability rule that kept giants like Tesla and Amazon out of the index for years. Those were active choices that shaped the index's performance.
One of their key tools is something called float adjustment. It sounds really technical, but it's a perfect example of what we're talking about. The committee doesn't just count up all of a company's shares. They actively decide which shares to exclude from their calculations, specifically shares held by long-term owners who aren't likely to sell.
So who gets filtered out? Well, insiders like CEOs and directors, other public companies, private equity firms, even some governments. They're making judgment calls about who counts as a strategic stakeholder. These are not automatic mathematical rules. They are discretionary decisions that fundamentally shape what the index is and how it performs.
So, what do we do with all this information? Now that we know the S&P 500 is really a concentrated committee-managed portfolio, how should that change our perspective? Well, this table sums it up perfectly. When we think passive investing, we assume it's unmanaged. The reality? A committee is making active choices. When we use it for benchmarking, we assume it's the objective market. The reality? It's just one specific portfolio. And when companies use it for performance reviews, they assume it's a fair peer group. But that group is constantly changing based on the committee's decisions.
Now look, does all this mean the S&P 500 is a bad investment? Absolutely not. It has been an excellent long-term wealth creator for millions of people. The point of this isn't to scare you away, but to empower you. You should just know what you truly own. Not a broadly diversified, passive snapshot of the economy, but a concentrated, committee-managed fund of America's largest, most profitable companies. And if that's what you want, fantastic. So I'll leave you with this one final thought to chew on. If the world's most popular and influential passive index is in fact actively shaped by human discretion, what does that imply about the other indexes and investments you hold? It's a great question to ask as you take a closer look at what you truly own. Thanks for joining me.